This episode is brought to you by DTC Design, your growth partner for high-performance e-commerce. If you're wondering what's holding back your Shopify store, DTC Design offers a free consultative conversion block report. That's right, no strings attached. Just contact them, set up a free call, and they'll break down exactly what your site needs. Again, D2C Design. On the show today, my good buddy, former guest of the show and friend, Matt Herz from Third Person. He is by far one of the sharpest guys I know when it comes to direct-to-consumer logistics. And the reason I wanted to have him on the show today is, one, our audience has a lot of D2C guys who listen to the show, but two is just to make sense of everything that's going on related to the tariffs, trade deals, and so on and so forth. He and I were going back and forth on a text, and I said, why don't you just jump on the show and help us make sense of this madness? So look, with the recent tariff changes that have been going on and continue to sort of evolve, we're here May 19th. What are your sort of high-level thoughts? And then are there specific verticals that are getting hit the hardest? What are you hearing? You talk to these folks each and every day. Give me the scoop.
Yeah, well, I'm glad you invited me back on, Dan. Usually I don't get a second shot with, podcasts and webinars. They only let me on once, and then I get my signal there, right?
Anytime, brother.
Well, thank you. No, I kid, only a little bit. But yeah, Dan, I think your question is, that's sort of the billion or trillion dollar question, literally. I think, in the last couple of weeks here, really since the start of the month, if it seems like there's a little bit more certainty in what the go forward world will look like, at least under the Trump administration. If we were having this conversation a month ago, there was a lot more uncertainty, nervousness, anxiety, particularly around the premise of having, 145% tariffs on goods with origin China. Like that would and has and will continue to impact a lot of businesses. That is detrimental. With Trump's announcement or the preliminary agreement between China and the US that tariffs will not exactly be 30%, because there's a little bit more nuance to there, because there's different levels of tariffs, but certainly a number that appears to be directionally about a third of where they were proposed to be as recently as a month ago. Somewhere in that 30 to 50% is probably where they will level out. Those are numbers that are a lot more amenable to brands, or where brands can, really function. So it seems like things are starting to de-escalate, which is good. Me personally, this is Matt speaking, I am a fan of global trade. I think there's a reason for it in globalization. Now, there's also a part of me that agrees that we shouldn't be, using air quotes here, ripped off. And I think we should get a fair deal. But, there's a lot of really great American businesses that employ U.S. labor, that pay U.S. taxes, that are being, or that would be severely crippled, if tariffs were in those kind of 3-figure ranges.
Yeah. Are you seeing the brands getting squeezed the most with on margin, price, and are they passing it on to the customer? What are the adjustments you're seeing right now?
Yeah, so it's a little bit of all that. So the techniques that I've seen is anything from, there are brands that are absorbing the cost. Right. Those with, significant margins. And when you think about 145% tariff, that is a huge number. But when you actually drill into it, and I'm not trying to defend it by any means, as I just expressed, but that is typically on the cost of goods, right? So if we just think at the, let's just kind of keep things simple here and say I'll make this up. You are Lululemon, right? Selling an $80 athletic t-shirt. Your costs might be $10, right? Probably a lot less than that, probably $6 to actually produce that shirt that you're selling for $80. So you take $6 for your costs. Now you're tacking on 145% tariff. So let's call it, for simple math, you're adding $9, right? Lululemon should still be able to sell that shirt for $80 with a $9 tariff and $6 costs and still have a business there. Right. So there are some brands that are absorbing that. There are some brands that are quietly raising rates. So maybe in the case of Lululemon, they're now charging $90 for that t-shirt, knowing that it's a more premium price and that their typical consumer can afford to spend a few dollars more. There are other brands that are, thinking through their supply chain and how they can, maybe take a hit in the near term, but kind of mid to long term, try to circumvent or, suppress those tariffs. So in the last couple months, the most common question that I've gotten from brands is, this idea of like a bonded warehouse or,
Mhm.
having a warehouse in a free trade zone where you can essentially defer tariffs. There's models. I've spoken to a lot of 3PLs and warehouses in Panama or in the Dominican Republic, heck, even Mexico, and other kind of near-shoring tactics where the brand need not pay the tariff immediately from China. So there's a lot of creative solutions that have been sprouting up as a function of this escalated tariff rate that we've been seeing the last couple of months.
What are you seeing from a logistics standpoint, the best brands doing? So you talked a little bit about bonded and free trade zones. What else are you seeing from a logistics standpoint that the top brands are doing?
Those are very common practices. Something else that I've seen is, brands are trying to work with their, well, if I take a quick step back, um, the recommendation that I have been given to brands over the last couple months is that, and again, this is just my bet, my opinion
Yeah,
is that, the 145% tariffs were not going to last, right? It
right.
was just kind of like, let's just shoot high and see how China responds to that and then
Yeah,
negotiate, right? And it seems like that is what has happened. So what I've told brands is, like, just wait, right? Like, if you don't need
yeah.
that inventory in the United States right now, like, just wait. And how can you wait? You can either literally hold the inventory in China, hold it with your
Mhm.
manufacturer, send it down to more friendly countries like Vietnam, like Mexico, like the Dominican, like
Mhm.
Panama, some of these other markets that I've said, and just hold the inventory until the moment where tariffs have de-escalated to a point where you can tolerate importing it. So this is essentially what like a bonded warehouse would do is like you can import it and you're not locked into paying the rate that is
Mhm.
in place the moment that it's imported. You only pay the rate at the moment that you actually export the product, which for most brands is to sell the product. So, given that this has all happened pretty quickly, from the moment that Trump announced his 145% tariffs to a week or two ago when the rate was agreed at a much lesser value,
Yeah.
something closer to 30%, I think only maybe a month or a few weeks had gone by. So, it's only for brands who or retailers who consume a tremendous amount of inventory, or if you were like a swimsuit company, you sell bathing suits and you really need that inventory right now,
Yeah.
and you imported that in the last month, you took a pretty significant hit. But for most brands, they've been able to kind of just wait and see what will happen. And now there's kind of a rush to importing now that relationships have de-escalated.
Yeah. I'm glad that you said that because we're seeing the exact same thing. And if I had to guess, I hope that within the next 90 days, something gets cleaned up. If it doesn't, that's a separate conversation. But for right now, I'm seeing it with our brands. They're doing all the same things that you outlined. And in the next 90 days, they can sort of function without taking too much of a hit or passing that on to the consumer or not eating into too much of their margin. Beyond that, the feedback I've gotten is, okay, then we really have to reassess, everything. Doomsday scenario. We don't get something resolved in the next, I'll say 6 months. What do you think happens? What are some of
Yeah,
the things that brands can do?
yeah, and I think on that point, Dan, I don't want to be Captain Obvious here, but I think it's important to note that like these decisions are not like we're not talking about software, right? It's not like
Right.
opening a computer, shutting a computer, opening a computer, closing a computer, where like it happens instantaneously and like there's no impact, right? Like these are significant decisions that brands need to make, and to use your term, Dan, doomsday, like you know, I've said this a handful of times, but like as an operator, like tell me the doomsday will happen and tell me what doomsday will look like, and I will figure out a way
Right.
to plan accordingly. Right? Tell me the tariffs will be 500% from China, and you know darn well that I'm going to do whatever I can to find a production facility that's not in China. So I'm not
Yeah.
impacted that way. What is difficult for brands is this volatility. It's this vacillation where, is it 150%? Is it 30%? Is it 0%? Is it 200%? Is it on this product but not that product, on a Tuesday but not a Wednesday, right? Like, it's this dance where it's like, how the heck am I supposed to operate and run a sound operation, whether I'm the head of supply chain or if I'm the CEO or an executive? And that's what's really difficult for brands. And moving production can take 6 months. It could take longer depending on the commodity. Like, even if you manufacture screen print T-shirts in China, like,
Oh,
that's not like, even that in the simplest form, right? Or like
yeah.
some, I don't know, water bottle, or something that's really simple, some plastic thing. Um, it's not easy to move
No.
production. Like, it just takes time. And by the way, all the big boys and girls, all the Fortune 500s have built in this contingency. So like,
Right.
they're already the first in line to move to Cambodia or Malaysia or Taiwan or any other
Yeah.
market where relations. So like take a ticket and stand in line. And that's what's
Yeah.
really difficult for these brands to, like, there's brands who are just like, you know what, China is the only market I can produce, and like, I just have to deal with this new reality that, like, the good times seem to be over, at least for now. The good times being the last, let's call it quarter century, where, there was effectively this like manufacturing arbitrage in China, and the current administration is not liking that.
Yeah. If I'm a DTC brand, what 2 or 3 pieces of advice would you give?
Well, I think it's now more than ever, it's really, really, really important to be dialed in with your economics.
Mhm.
Really understand your business, your financials, your unit economics, right? Like, if you're a brand that cannot absorb a few dollar increase, then there's an argument you might not, you probably shouldn't be in business, right? And I'm
Right.
exaggerating a little bit because there's some really low margin businesses, but I think it's really, kidding aside, it's really important to be dialed in with your economics. Um, it's really important to use this opportunity to negotiate with your suppliers.
Mhm.
You should always be negotiating with your suppliers, whether it's your fulfillment partners, your shipping carriers, your manufacturing facilities. But I think there's a generally accepted uh, notion right now that, like, times are tough, and brands are getting squeezed, and now is a really good time to have those conversations, to whether it's extending out payment terms or negotiating the pennies and the basis points. So really
Yeah.
focus on that side of the house. And like, something I instructed a few brands a couple of weeks ago, when tariffs were still elevated, was like, think about whether you need that Memorial Day sale or that Mother's Day
Yeah.
sale or that Father's Day sale, or like, you don't have to give out that 20% promo code just because, right?
Yeah.
If a brand wants to buy your product, they're willing to pay full price. So really rethink, like, the economics up and down your supply chain, and don't just kind of rest on your laurels with the same things that have worked for your brand thus far.
How are the 3PLs doing? On the front end, you have all you ever read now is how marketing budgets are getting slashed in the DTC space, right? All the Facebook spending and whatnot has really fallen off a cliff. And then on the back end, you have all the things that you outlined, which was, them inventory being held in these different zones to avoid the tariffs. How is the 3PL industry doing right now?
Yeah, I mean, from what I've seen, the US 3PL market continues to be very strong. Um, I'm not sure I would have thought that if I were to have taken a bet or a guess, but it continues to do really well. And
Good.
I think part of that is because e-commerce, despite the headwinds of the consumer and spending and inflation and all that stuff, like, I mean, I know you follow the markets, Dan. You look at Shopify, who announced their quarterly earnings, their Q1 earnings last week, or maybe it was 2 weeks ago at this point, a few days ago, and their GMV, their gross merchandise value, which is basically the total amount of sales that were generated on, across all their merchants on Shopify quarterly, was 75 billion, and that was a
Oh,
25% increase year over year. So
that's
Q1 of
incredible.
last year they did 60 billion. This year they did 75 just in the quarter in Q1, which is a slow quarter, right? So
it's amazing.
Yeah. So A, like Shopify is a beast, right? B, like, and by the way, more importantly, on the conference call, on their investor call, they said that they anticipate the final 3 quarters of the year, 2, 3, and 4, the duration of the year, to be up in the 25% range quarter over quarter or year over year for each quarter. So they basically predict that, at least in their business now, they are taking market share. It's not just organic, but like 25% at that scale is massive, right?
Massive.
So I saw that and I was like, e-commerce is still healthy. So I digress a little bit, but to bring it back, Dan, to your question on like the health of 3PLs, while I don't believe e-commerce will grow 25% as a whole this year, it'll probably be like in the high single digits, maybe 7 or 8%. But if you think about the industry, like e-commerce in the United States is over $1 trillion. I think it's about 1.2 trillion. So there's literally $100 billion of new e-commerce value that is being created this year in the United States. And a big portion of that is going towards 3PLs with fulfillment. So I'd want to be a 3PL in this market. Yeah, I do want to be a 3PL in this market. I think it's a good place to be.
You are, I used to own a 3PL, and I consider you one of the true experts when it comes to 3PL logistics, but specifically for the D2C marketplace. Matt, before I let you go, how can people find out about you?
You can email me, Matt, M-A-T-T, at thirdperson, T-H-I-R-D, the number third, and then person.co. We were too cheap to buy the M at the end of .co. Find me on LinkedIn, Matt Hertz. Reach out to Dan. He's got my info, and happy to chat to any brands or 3PLs or logistics providers.
Not only is he an expert, he's actually an excellent LinkedIn follow. He gives you all kinds of advice, tips. He's very, very strong on his LinkedIn posts. My brother, I am glad that we could do this again. I hope to see you at the National Card Show later this year, and we could talk about our second favorite subject, which is baseball cards.
Absolutely. Nice to be here, Dan.
All right, buddy. Take care. Once again, I want to thank our sponsors, D2C Design, your design firm for anything related to Shopify, e-commerce, and your website needs. Again, you can find them at d2cdesign.com. Thanks.